We'll fast forward that into the second half of 2022, and now we're going to put our history hat on, because now we got to go back to 1788. So just post-date, the French Revolutionary War was the last time we saw a 10-year treasury draw down anything near what we saw last year.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. Special guest today is Brad Kasper, president and founder of LSA Portfolio Analytics. This will be Brad's 7th time on the Guided Retirement Show. We're going to tackle all things economy and markets and interest rates. You do not want to miss this. After you listen or watch, if you're watching us on YouTube, make sure to share this with your friends. Enjoy my conversation with Brad Kasper. Before we hop into today's episode, I want to remind our listeners and viewers that you can access the same financial planning tools we use for our own clients on your own time, and all from the comfort of your own home. All you need to do is visit the link in the show notes and click the Start Planning button. From there, you can start building your retirement plan, no cost, no obligation. All right, Brad Kasper, welcome back to the Guided Retirement Show. This is episode number 7 for you. Last time you were on was episode 69. It was about a year ago, and we were just rolling into this like massive, quick increase in the Fed funds rate, and Jerome Powell woke up one morning and decided that maybe inflation wasn't transitory like what he said back in 2021, and we kind of made fun of that a little bit. We had gone through the Q2 GDP report showing a negative number, and that was the second quarter of negative GDP, but they wouldn't define it as a recession because of whatever reason they wanted to change the definition. But I'm glad you're back here today, because when you and I get together here on the Guided Retirement Show to talk economics and markets, it's always fun. So welcome.
I appreciate it, and it's always a pleasure to be with you. And yeah, it seems like, a year ago today, we're talking about the complexities of the market, and here we go again. So Looking forward to it.
Well, and we were talking at that point in time about how, there were still some severe headwinds with equities. There still were some severe headwinds with fixed income. And 2022 wound up being the worst year, I think, on record for fixed income, where the typical 60-40 portfolio just didn't do what it was supposed to do.
Yeah, in large part, it was the fixed income side, right? The bonds. And I know we spent a lot of time on the last episode talking about bonds, and we were only partially through the year of starting to see some of the volatility. But boy, by the time we got through the end of 2022, you set a record, right? At the time in our last show, we were talking about the late 70s was the last time we saw bond drawdowns similar to what we had seen at the moment. So we were talking about a 50-year time frame that we really haven't witnessed the pressure that bonds felt last year. We'll fast forward that into the second half of 2022, and now we're going to put our history hat on, because now we got to go back to 1788. So just post-date, the French Revolutionary War was the last time we saw a 10-year treasury draw down anything near what we saw last year. And that might sound absolutely wild, and it is in so many ways, to think about what a 10-year treasury bond looked like in 1788. But in reality, it was the last time that we even saw, the double-digit drawdown profile that we saw out of fixed income last year. So those that think bonds were just missed a little bit last year are sorely missed. It was a wildly challenging year for bonds, and it ended up hurting the average 60-40 investor, because when you have fixed income as kind of that lower risk ballast of your portfolio, and you're leaning on it as kind of the protective sleeve, boy, it didn't work for you last year.
No, it didn't, and it caught a lot of people by surprise. And we've seen that reprieve a little bit here in 2023, but you haven't really seen any kind of a major rally in fixed income either. And that rally probably won't occur for quite some time. And I'll get your take on this. My take is that we see interest rates remain elevated for, I'm going to say, at least the next 3 quarters, maybe even the next full year. What do you think?
I think you're absolutely correct. And let's put this into perspective, right? We came into the year, and most economists and strategists were talking about the Fed potentially lowering rates at the tail end of this year. That seems to be well off into the future at this point. We saw in January the Barclays U.S. Bond Ag went on a run, right? Everybody that was talking about there is a tremendous opportunity in bonds. I don't think they're wrong. I just think we were early, right? And so January started to give us an indication of how bonds could potentially behave when we get through the worst of what the Fed is doing. But then you get through the end of first quarter, and what comes back into the language is some additional rate increases. And although they're happening at a much slower pace than what we witnessed last year, it's still having an impact, right? So a lot of those early gains in bonds were given right back to the marketplace because we're seeing the 10-year shoot right back up. Yeah. And we seem to be in the same, problematic scenario that we found ourselves in last year, with one big difference, right? We're not, the pace of where we're going with these interest rate movements are completely different than what they were in 2022.
They are different, and it's interesting as you and I talk, and we produce this episode of the Guided Retirement Show. It's August the 16th, and today Jerome Powell came out with a speech, and he said that they have removed the word recession from their forecast. So Jerome Powell seems to believe that he also said don't expect any rate decreases this year, which I didn't in the first place. I don't think you did either. But he seems to be trying to paint a picture of the proverbial soft landing. We got inflation under control. Everything's fine. The economy's going to slow a little bit, but don't worry, it's not going to go into a recession.
Man, there's a tremendous amount to unpack there, right? So let's start with inflation under control. It is true that the year-over-year inflationary number looks a whole lot better. But remember, we're looking at 12-month windows of inflation. And so when you had the massive drop, it's rolling off some really big numbers on the backside of it. And the change in those numbers is what it's representing. I would argue that most of the listeners that are following the podcast and listening to the show are probably not feeling that big reduction of inflation, right? The grocery store is still expensive. Price at the pump is still expensive. So we're not really feeling it, although the data is suggesting that we're in a healthier range than where we were 12 months ago.
Well, it's not reversing the effects of the massive inflation. It's just slowing the rate of increase.
Right.
Right?
Yeah. I mean, to get back to more traditional levels, you're talking about years that it could take. Right? We had tremendous supply chain issues. We had geopolitical concerns going on. We had energy running through the roof. I mean, these things run up in price very quickly, and then they're very slow to decline. So when I think about where the Fed is at right now, I think inflation is still their primary target, but they still see it as being a little bit hot, and I think that's why they continue to stay engaged. So let's circle that back to another statement that you had made with the Fed. The idea of using language is a huge tool within the Fed's toolbox, right? And the idea of saying recession is out of the picture, I think, is a lot of front running for what they hope to kind of play out. But you have to be very careful with that, because the Fed doesn't have a perfect record of using language to kind of direct the markets as to what actually plays out. You already used one of the words, and the term was transitory, which seems to be the biggest cuss word in our industry anymore, because we were looking at and being fed from the Federal Reserve, no pun intended, that the transitory was going to be short-lived within inflation, and here we are years later still talking about it. So
look, we're talking about a beast of an economy that is not something that can be controlled with the flip of a switch. All right, I'll go back and give another example of when the Fed was dead wrong, and that was in the summer of 2008. And if you'll recall, that's when the subprime mortgage crisis was really kind of entering its worst time frame, and I believe it was either June or July in 2008, and you may recall this as well, when Ben Bernanke, the then Fed chairman, said that the banking crisis was under control and that the worst was likely behind us, and that the Fannie and Freddie, they'd stabilize and everything was going to be just fine. And then it wasn't even a quarter later that Lehman Brothers went belly up, kind of poof into the night. We had to bail out Freddie. We had to bail out Fannie. major banks had to be bailed out, major insurance companies had to be bailed out. And so that was something that was very, very close to occurring. And yet the Fed chair at that point in time says, hey, it's all under control. It's fine. So you have to take what Jerome Powell says, that we can take the word recession out of the vocabulary for our forecast with a grain of salt, in my opinion.
I would agree. I mean, going back into the 2008 timeframe, these are people that have probably the best pulse of what's going on with the domestic economy, global economy. And when you come out and you miss a statement like that, suggesting that the financial crisis was under control when it wasn't, or suggesting that inflation is transitory, language has meaning. And when you sit there and say recession is out of the cards, I'd be very careful with it. Now, I hope he's right. And I would never want the Fed's job in a million years. They're trying to deal with something that's wildly challenging. But if I go back to why do I think he is saying it? Well, I think the Fed continues to play a role in this kind of soft landing narrative that, again, is language, right? What does soft landing really mean? And at the end of the day, I think what they believe is that they can fabricate a soft landing if needed. And I'm going to give you an example. So last year, the Federal Reserve started down the path of unwinding their balance sheets. They became a $9 billion behemoth on their balance sheets, right? Nobody voted for this. They just grew their balance sheets as quickly as possible. Now, we fast forward into 2022. They're looking, and I think I said $9 trillion on their balance sheets. My apologies. You come into 2022 and the Federal Reserve steps in there and says, this is not what the Fed was intended to do, so we're going to unwind our balance sheets. So what did they do? They started dumping some of these bonds back into the marketplace in 2022. And they did so at a pretty decent clip. And if I were to take a step back, I would say, hey, there's probably some correlation to equity prices, to bond behavior when the Federal Reserve is getting out of the way of backstopping the overall economy. And, I tip my cap to him because I think that going through some of that painful movement puts us in a healthier position where real price discovery can happen and fundamentals matter again. And they were on a tremendous path, even through 2023 until when? Well, until we hit our first bump in the road, which was SVB, right? Silicon Valley Bank. They go through their bankruptcy. They are collapsing. It's sending a ripple effect through the regional banks that are out there. And what's the first reaction that the Federal Reserve does? Well, they opened up what was called an overnight lending window, of which we saw about $750 to $800 billion tapped into overnight from all of these regional banks. And I'm not suggesting that it wasn't the appropriate decision to make, because what did it do? It allowed these banks to continue to be solid on their money market positions, make sure that they had plenty of reserves to operate through this event. But how does the market interpret it? Well, to me, it's once we find pain, if the Fed is going to continue to step in and bail us out of those painful moments, this is where I start to think about, is there a fabricated soft landing that the Fed has in mind? Because definitely that movement in March would suggest that they're going to continue to be a player in backstopping this. And now the question is, what are the next couple of bubbles that we have to be thinking about? And we have some ideas of where some of those bubbles could be.
Well, so let's stick on the banking issue here for just a minute, because just this week, the Fitch, which is one of the rating agencies out there, made a statement that they think that they're going to have to downgrade a lot of the major banks and a lot of the regional banks. And I've got my theory as to why that's happening, but I want to hear yours first.
Well, I think it's twofold. I think there are two big bubbles that the markets are going to have to be thinking about in the next 6 to 12 months. And again, I don't suggest these bubbles to try to time anything here. We're here to think through from a portfolio perspective, from an investment perspective. We want to make sure that we're looking out and just trying to identify what are the potential risks that we're facing. And it's okay to have these thoughts. The bigger plan is to think through, how is my portfolio behaving through these events, and do I have good risk controls associated with it? And I'm sure we'll circle back to some of those topics here in just a second. But there's two bubbles that I think people should potentially be aware of. One is within private credit. There is a massive wall of private credit that is coming due within the next 6 to 8 months. And when that private credit comes in, guess what? They're going to have to extend out those loans, that debt, right? But they're not getting the 6-7% rates that they had 5 years ago, 10 years ago. They're now going to have to re-up that debt at about 12 to 14%.
So this is going to hurt the company.
Going to hurt the company. Yeah, it's going to be hard to pay those obligations,
So before we go too far, explain private credit, because you have a corporate bond, right, which is not anything like private credit.
Yeah, and this could be a whole episode in itself, right? So when we think about debt, there's two different sides. You have your treasuries, which is all government backed. Then you have corporates. These are companies that are out there that need capital. So what do they do?
Debt, right?
So they generate bonds. They provide them to the public. There's capital that comes in, and then they pay the interest on those obligations back to their investors over time. That's the general concept of a corporate bond. But over time, some companies are very different than others. And so what did we do? Our industry has higher quality corporate bonds and then lower quality corporate bonds. Those that dip down in quality are often called junk bonds. What listeners might be aware of these as high yield bonds. Well, about 5 years ago, you saw this real big movement from the high yield space, where people were having trouble getting good rates because of the quality of their companies.
But didn't a lot of that having trouble with getting good rates have to do with a couple of different issues? Number one, the lending restrictions on
Absolutely.
Major banks. That was tightened down severely after the financial crisis. And then the second reason why companies would seek after private credit would be that they don't want to go through the public bond offering and all of the steps that they have to jump through. They maybe need the money a little bit faster, and so they're willing to pay a little bit higher rate to borrow it from a private entity as opposed to this being a public issue.
That's right. And so this is where private credit came into play, right? There was a number of people that were out there with the financial means to step in there and provide the capital for some of these bonds at higher rates so that these companies could tap into a good line of credit and, go down to what was traditionally kind of a high yield type of space, but it's a new category called private credit. Well, that's great, but private credit has grown tremendously.
Yes.
It is now it's about a $1.4 trillion asset class, which is roughly the size of bank loans these days. So when you have all of these companies that are now using private credit at slightly increased rates versus what you could do if you went through the more traditional channels, that was fine. They were willing to pay the increase so that they could receive the capital. But now a lot of that capital is coming due. That's what I talk about with this wall of debt that's coming due. They do these issuances for a certain term, right? A certain time frame. And when those bonds come due, they now have to re-up that capital if they still need the money to continue to operate.
So either A, the company's got to have enough cash to pay off the debt, or B, they're going to have to refinance that debt through private credit again at a higher interest rate.
Yeah, and if they have to refinance at 14%, Dean, what do you think is going to happen to these companies? We could potentially be in a movement where the default rates on private credit start to increase. And when I start talking about default rates, and a lot of investors have probably heard of this within the high yield space, and I do think a portion of it trickles into the high yield, probably to a lesser degree. But at the same time, there could be a massive pickup in default rates, especially in the private credit space.
So if that happens, that means that you have companies that are filing bankruptcy.
Yep.
You have companies that are laying off employees.
But don't worry, Fed took recession out of the picture here. So.
Yeah. You have companies that are potentially closing their doors.
Yep.
Or the flip side of that is, if we're going to be able to pay this debt, we have to raise our prices. And if we got to raise our prices, what's that do to the transitory comment of inflation again?
Inflation goes up, and we talked about this on the last show as well. The only thing that kills higher prices is higher prices, and this is the equation of how you get there. It's taken a lot longer than what we had probably expected, but you still see the formula in play where really what I think the Fed is hoping for, and what I think markets are hoping for, is that we grow our way out of it. And I just don't see enough growth yet. Not to say that we can't have it. Like I hate doing these shows where we're constantly pessimistic about certain things, but I want to be very realistic about true headwinds that are out there. And I don't see a scenario where we're growing at a rate quick enough to kind of outpace some of these concerns. So I have a hard time seeing how we grow our way out of it.
Okay, so let's flip that on its head then and go from private credit to the banking industry, which has the exact opposite problem, and that is that they have loans on the books in the form of mortgages at 2.5%, 3.5% in an environment where I can go out today and buy a 3-month treasury at 5.25% or better. And so in order for the banks to be able to compete and to get the deposits that they need in order to, support their reserve requirements, they're going to be forced to pay a higher rate on the deposits than what they're getting on the loans that they have out, which is why I think Fitch is saying, hey, we may have to downgrade some of these banks because their P&Ls are all messed up. And if we don't, look, the best thing that could happen for banks is if we had a recession. So they want to tell Jerome Powell, put the word recession back in there, because as soon as we go into a recession, we know what the Fed's going to be forced to do.
Right.
They're going to be forced to lower rates, which would be great for banks.
Right.
Right.
Yeah. And again, keep in mind, if most of your pundits were expecting rate cuts to happen at the tail end of this year, when you start to think about your business planning for some of these banks, they weren't necessarily projecting this to to be prolonged through 2024 or maybe even 2025. Who knows when the rate cuts start to happen? But I want to circle back because you hit nail on the head. That's our second bubble that we're concerned with: commercial real estate. The amount of debt that these banks have on the books is somewhat problematic, and there's two different sides of it. You elegantly described one side. The other side is some of these distressed cities where we now have low occupancies within corporate buildings. We have examples of like Target up in Minneapolis just shut their doors, and they said, no, we just can't handle it anymore. So this is debt.
That was a crime issue.
Yeah, it's a crime issue, and you see it in very pocketed areas all over the country. Yeah. But at the same time, I mean, it is compounding on itself where these regional banks, and somebody asked me a great question, do I think regional banks are through the worst of it? And I do think that they are healthier than where we were in March and April because they had to clean up their books very quickly.
And far healthier than where we were in 2008.
Absolutely.
Yeah.
But do I think that they are through the worst of some of the debt issues that they still have on the backside? No. And I think, these commercial real estate is a big portion of that. Now, again, I want to put my optimistic hat on because there's a tremendous story with that Target up in Minneapolis as well. Apparently, there is a private real estate group that came in, and they bought up the Target, and they are going to work to turn that into a residential property. Now, I don't know about you, Dean. I don't see too many windows in a Target, and I don't know how the heck they're going to do it, but I tip my cap, right?
Big house.
So what do they see, though? They see a problem. And just like, the strength of American companies, American ingenuity is a very powerful thing. You have somebody stepping in, seeing a distressed opportunity to make something good out of it. And I hope they do. And if they do, maybe it's the blueprint of where we do find the growth pattern to get out of it. But right now, these are headwinds that hopefully turn into tailwinds at some point in time. But we're going to have to be patient. You're going to have to be wildly observant of risk within portfolios to make sure that you're thinking about it properly.
All right, a couple more topics here that I want to cover while I've got you on here. Have you heard the term a Richsession as opposed to a recession? All right, so unemployment has remained stubbornly low, which we would view that in a normal environment as positive. It's strong, people are working, etc. The term Richsession comes from kind of the opposite of a recession, where typically when the economy softens and it slows, it's typically the lower income people that start to lose their jobs first. We're seeing that as an absolute opposite in what's happening in the job market right now. What you're seeing is the banks, the tech companies, those types of companies are the ones that are doing most of the layoffs because of the pressure that they're under. And the technology companies, I believe, are going to be caught in this private credit and overextended debt scenario that you talked about quite a bit. And so that's going to force layoffs at the higher end of the white collar jobs as opposed to the blue collar jobs. And so I don't know if you've heard that term or not. It's been thrown around just recently. I think it's kind of a buzzword at this point, but
I have not heard it, but getting my mind wrapped around what you're talking about. Yeah, I think that there's a number of companies out there that are going to have to make difficult decisions, and dependent upon the stress that they have on their books, it could be the higher earners that are finding that are out there having to find new jobs and new positions. So, yeah, I think there's a scenario where that could play out. The other thing that you talked about in terms of the stubborn unemployment rate, and again, it's funny to talk about it in a negative lens because that's such a positive thing to have unemployment at such a wonderful level. But at the same time, last year we didn't define it as a recession because employment stayed strong. And if we're going through this again, is the Fed leaning on, a strong unemployment number? Because that could be wildly dangerous as well, especially if you start seeing some of this rotation. And, at the time that we're doing this, right, keep in mind, we just went through half a year where the S&P's up 20% and the Qs, the technology's up 40%. You would think that this is the most euphoric time where we're talking about all this growth and opportunity, but you don't have to go too far to say, man, some of this just feels like we've gone way too far, way too fast. And I think what you're addressing with kind of this Richsession idea, and I'll have to get used to saying that, is these companies that have run quickly may not be quite as healthy as we believe. And I think it circles back to my previous comment. Earnings are going to matter. And some of these names that have been high flyers, partially because they got beat up last year. There's a big narrative that tech is growing because of the AI movement. And I think that there's definitely some truth to that.
A little bit of hype around it too.
A little bit of hype around it too, right? But at the same time, these names at some point are going to have to settle down and either have better earnings as they're going through to validate some of these valuations that we're finding ourselves at.
So you've got Apple, Amazon, Microsoft, Tesla, Meta, Google. What's the other one I'm missing? NVIDIA. Okay, those 7 stocks, they've now nicknamed them the Magnificent Seven. Okay, those 7 stocks make up over 50% of the market capitalization of the NASDAQ. They're making up the vast majority of the return of the NASDAQ. Those 7 stocks make up 25% of the capitalization of the S&P 500, and those 7 stocks are driving the vast majority of the return of the S&P 500. I have not seen a scenario where you have such a narrow group of companies that are driving the entire markets since 1999.
I agree. And I think I shared with you before this, if I read one more article from Barron's talking about the top names in these indexes driving majority of the return, but it's absolutely true. And when you take one step removed from those big names, you see much more muted growth. And it's hard though, right? Because
here's an example, Brad. You go look at price to earnings ratio on Amazon. Okay, the last time I checked was a week or two ago, and it was 311. Okay, and that same day I happened to say, okay, let me check the price to earnings ratio of some of the big energy companies. Most of them are 7, 8, 9, right? They're high single digit price to earnings ratios, and even when you look at, you get a bunch of companies out there that I think are undervalued at this point in time. They've not done anything to help the market participation. At some point, don't you believe that we have to get back to more normal kind of ratios there? So either A, all these other companies, their PE ratios need to rise to come up to fair value, or B, some of those ones that are out of sight right now need to come back down in order to get the ratios back in line.
Or a combination of the two.
Yeah.
Right. I mean, you're preaching diversity, right? And I think diversification within our industry is becoming a bit of a cuss word, right? Because we're all looking at the S&P 500 or the NASDAQ, the Qs, and we're saying, man, seems to be where all the growth is. But the reality is...
Here's the interesting thing, though. Here's the interesting. If you take the S&P 500 from January 1st of 2022, or you take the NASDAQ, the Qs, from January 1st of 2022 through today, you're barely to break even.
That's right.
If you are even to break even, right? You're probably still slightly negative. Yet if you took the equal weight of the S&P 500 and you went from January of 2022 through today, you're in almost an identical position, but you just didn't have those wild swings.
Rides.
You didn't have the wild swings.
What's the power of diversity, right? There's value in having good exposures across names within your portfolio. And it's hard because a lot of these names that you've carried over the last, 4 or 5 years or even 10 years plus, they haven't kept up with the octane of some of these high flyers, but we keep watching these high flyers continue to hit multiple expansions that are ridiculous, PEs that are out of sight. And rightfully so, these are good names. Like, I don't want to downplay that there is a role that they have definitely played within our economy and have served well to have the growth that they've had. But at some point, as well as I do, that's going to shift. I mean, even if you look at last year, like the value names relative to growth names were a much better performer. That's where your equal weight conversation, the power of equal weight was just leaning more on the impact of diversity within a model or within a position. And it played its role last year.
What was interesting last year is that financials and energy both did really well.
Yeah.
Right? And this year, it's really just the opposite.
Yeah. And so, what's that attribute to, right? You have to go back and say, I don't know who's going to be the next categorical winner. Yet every year, we come into the year and say, oh, do we think it's a growth market or a value market? Do I think it's a large cap versus a small cap? And, there's a fair amount of speculation that goes into it. Just the same as the speculation. I don't know if the Fed's going to raise another 25 basis points or 100 basis points. And gosh, if you listen to our last call, we envisioned the Fed capping out closer to 4%. So, and I share that with, complete humility. The one thing about markets is they will sober you very quickly, right? You can have as much information in front of you as you think and think that you have good controls. And then all of a sudden you'll figure out that there's something out there that's beyond what we understood. And that's what we saw with the Fed. And same thing with the large cap, small cap, growth versus value. Here's what I kind of circle back to though, Dean. The role of both are significant within an overall strategy, right? Instead of sitting here and speculating who's going to be the categorical winner and making that bet year over year, where you're going to get those odds wrong, probably more than a few times, this is where we talk about, we'll split it, have some growth. I do think that growth and the technology and the Qs play a very significant role in real alpha generation to portfolios over time. So there's a role that they're playing, but the value names have a role as well. And that's more of the defensive posturing like 2022. We're sitting here at a pretty significant high in the markets at the moment where our PEs are starting to go back to levels that they were last time we were having this conversation. And so when we get to those levels, I don't want to make big bets one way or the other. I want to know that I have good exposures on both sides so that I can find a smoother ride through these events instead of trying to make big bets at each event.
All right. One other real quick sector that I want to discuss, and then we're going to wrap it up because we like to keep these things around the 30, 35-minute mark, and we're running up on that time here. Residential real estate. There was speculation that residential real estate was going to start to come down in price, yet we're not seeing that. In fact, we're seeing, again, people bidding at ask or over to get a home. What are your thoughts on residential real estate?
I think you're still hooked to rates, right? So we're going to have to watch Fed activity to see what happens there. But I do think that there is a path where residential real estate stays fairly healthy through this. Historically, if you go back through real recessionary events, residential real estate does pretty good. And I know that seems counterintuitive, especially in a rising interest rate environment. but there's perceived value in those homes, and you still have a tremendous amount of people that are looking for homes.
Right.
The problem is the real estate is so stinking high, and when we talk about all the kids that are still living with their parents, it's because the price that they have to pay to get into a home today at a rate that is, higher than what we've had to do over the last couple of decades has made it incredibly challenging. It's not that the demand side isn't there. The price is just keeping them out of the markets. And so can there be a bit of a balance? Yeah, we might see a healthy reset, but I think the demand there is big enough that it keeps it a relevant asset class.
Yeah, my opinion is I don't think we see real estate prices go back to where they were in 2021, early 2022. I think those real estate prices are going to remain elevated for the supply-demand issue. I think apartments stay healthy because you got so many people that are locked into somewhere between 2.5% and 4% mortgages, and if they want to move, they know that they've got to go get a new mortgage at over 7% today, and so they're staying put, which is, that's the supply side of things. So that's remaining extremely tight, and I believe that will keep the home prices elevated. And I think the consumer's strong enough at this point in time for us not to have any worry about major defaults in the residential real estate industry or that sector like we saw happen in the Great Recession.
Yeah, I think those are all healthy points, and I'll use myself as a prime candidate. My house, even though we're always looking for ideas and just out there as investments as well, right? But at the same time, I'm not going to sell my house, even though I can get a premium for my home, because I'd have to then go out there and shop an elevated price at an elevated interest rate, and it's not nearly as beneficial to my family.
Right.
And I think a number of people are feeling that like-minded experience. And so, real estate should be interesting. I don't see this massive reset that some people have been fearful of. There's definitely some supply-demand issues that will come through, but I think that it stays fairly healthy.
Only place I see that's in office.
Absolutely. Commercial real estate's completely different conversation.
But not all pockets of commercial, just mainly office, some retail, depending upon location. But I think your warehouse space, your life sciences, there's a lot of parts of the commercial real estate that I think are going to weather through this very strong.
Well, go back to global shutdown, right? Everybody started working from home, and a lot of them continue to work from home. But what's really interesting is if you look at some of these companies that have established buildings that are out there, go look at the amount of money that they are pumping into those buildings, because what they're trying to do is increase the attractiveness of coming into the office and actually working.
Right.
And really what they're trying to establish is if we're going to have this big monstrosity of a building where we're driving our employees
back in the office.
Bring them in. They should be in here. And if not, this is kind of the catalyst, then maybe there's a different formula out there that works. But it's been pretty interesting to watch the sheer amount of dollars that have been pumped into these buildings to get people back into the office. And rightfully so. I think that we'll see a greater deal of that continue to happen.
Well, Brad, this has been insightful as always. Always a lot of fun to get a chance to sit down and talk with you about the markets and the economy and interest rates and the Fed. And I think that we should probably do this again either late this year or early next year, probably next season. One of the early shows of the Guided Retirement Show, we'll have you back on to kind of see how our thoughts panned out.
I think so too. I mean, right now we're at a moment where people are fearful of missing out. We're at a moment where people have certain returns and they want to get the heck out of the way. It's a very kind of polarized market environment at the moment. And unfortunately, our crystal ball is as clear as anybody else's. And so we just got to be patient. But I do want to leave listeners with this. I think that it's a very interesting time for diversity to kind of come back into play and really start to be the buzzword again. You started touching on it with the tech and versus value, or growth versus value, but I think that extends into the fixed income conversation and across asset classes. So this is one of the most excited timeframes I've been around the real role of diversity and risk controls within portfolios. I think we're going to find it's a pretty meaningful market cycle to have those conversations.
I totally agree. Brad, thanks again. Hopefully we didn't confuse you too much with some of the buzzwords that we used. It's difficult sometimes as we get to talking about these things. Hopefully it was enlightening for you. If you didn't catch it all and you didn't understand it, go back, re-listen, or reach out to us and let us know how we can help you. Thanks again for joining us on the Guided Retirement Show. Don't forget, we're offering you access to the same financial planning tools we use for our own clients. Just get out to the link in the show notes and click the Start Planning button and begin your retirement plan from the comfort of your own home.
starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Modern Wealth Management, LLC, an SEC-registered investment advisor.